So to round out our cash flow positions, or our positions where we want to look to benefit, opportunistically rather than protection, will be owning a put. We know the word long means I'm going to own it. If you remember when we went to the section on long and short, long positions are, assets are something that we own, and liabilities are something that we owe. And this could be something that we have borrowed, just to review, or it could be a promise. Remember that you can remember that we borrowed in the United States, my home country, as of this recording, about 23 trillion, and we've promised about 150 trillion. So 180 trillion between the two. This is money we've actually issued bonds for and collected money for and spent. This is money we've promised to people, so it's two different things. But long means we own it. So if you own stock, you're long stock. If you own a call option and you paid for that call, you're long a call. Now we're going to talk about put options. And I tell you, when I get interviewed, or I've done podcasts, or whoever wants to talk, one of the things that I share is just a personal thing. I can't imagine trading stock by itself without having the ability to control some things through the option. And so we're going to talk a little bit about this, because a long put can help you take advantage of a position, where you think, as we look at the four pillars, if we think a stock price is going to fall, going short can be very, very risky, but long puts, not bad at all. So we'll take a look at the difference between those risks, and you'll find that being long and a call are very similar, other than that your risk is more limited with the option in terms of how much money you can lose. But with your percentage, that time decay is gonna get you. And the time decay got me on one recently that I'll use as an example, and we still made money on it. But we'll show you. No trades are perfect, but I'll show you maybe a good one here, a good example of something that something will give you the idea. So long put. So long put involves paying a premium to have a bearish downside. And as we look at this little risk graph, I know that the price of the stock would go this way and this way. This is just a very crude representation, but it's really healthy to see how this works. And then this would be the profit, break even at zero, and loss. So profit and loss. And we can see that the profit really goes up as the price goes down. So this is a way to be opportunistic about this. Now, I've mentioned cash flow a lot, and we started with our cash flow trades where we end up making promises instead of buying choices. And but I'd be remiss if I didn't talk about these, because from time to time, this can be really a fun way to look for an opportunity, right? So nothing wrong with doing that. Buying puts, this is less risky than the shorting the stock. And I'm going to bring up a couple of risk graphs as you get more and more familiar with them that'll show you the difference. We'll put them side by side of what may or could happen. But the long puts are going to have that time decay. So again, remember that gallon of milk in the refrigerator with a expiration date on it. Someday that milk's going to sour and it's going to be worth nothing. Well, that's the same with these options. Someday they can be worth nothing. So that stock has to do what you hope it does before the time runs out. Before the timer runs out, it's that simple. Got to make your ice cream before the milk sours. So our objectives, excuse me, frog in my throat. We have a bearish outlook on the stock. A much lower capital requirement. When we short stock, we had those 4 steps of borrow, trade back, and return. Well, to borrow, you got to have collateral, right? You got to have some capital to borrow that. And so this is maximum risk premium paid. Remember, when we buy an option, and we're long an option, whether it's put or call, the most we can ever risk is the premium we paid. Now, why is that? Think that through for a minute. Why would it be just the premium you paid? Well, it makes sense because it's an option. It's a choice. You don't have to do anything. You don't have to commit to anything. So if I hand you $5 to have a choice to do something, well, great. If I decide not to do it, I'm out $5. That's it. I walk away. So the maximum risk here in this long call is the premium you pay. That's the most you could lose. And it's got huge downside potential. What that means really is if the stock falls, there's a huge potential to the downside, which is really, really good. I still call this aggressive, even though I've said that it's less aggressive probably than shorting a stock. But again, you have to remember that the reason that is time decay. That's the biggest reason I put these as aggressive. Other people might not agree with me on that, but I respect everything as aggressive. So let's draw this out with our two people here, and that'll help us understand it. I'm the buyer. So right here, this guy has a choice. He wants or has, he has a choice or the choice. And he has a choice to sell something here. And, maybe it's XYZ stock. XYZ stock. So here's the stock down here, and maybe it's trading at $100 right here. And he says, I'd like to sell this stock, and we'll use an at the money here, at $100 per share. And of course, this is going to be good for 100 shares, right? Because it's one contract. And maybe this is like, we'll just say, 2 months, something like that. Well, there'll certainly be a premium that you're going to pay. And just remember, the person that makes the promise always collects the premium. The way to remember that is insurance, right? If the insurance company promises you to fix your car, you pay them the premium. If they promise to insure your health, you pay them the premium. If they promise to fix your house, if the big bad wolf blows it down, sure enough, they're going to make that premium. So this entity over here, this person, he or she makes a promise. And since you have the choice to sell, they're going to make a promise to buy this stock. So they'll buy XYZ, and they're going to do it at that price, at $100 per share. In this case, is the strike price. It's an at the money option. And they say, sure enough, we'll make that good for 2 months. So the time is ticking away, right? You got 2 months now, and you sent them a premium of some kind, some type of money, maybe $5 per share, whatever it is, $2 per share. I'm going to show you one that's less than $2 that I did that I didn't work out perfect, but worked out okay. We made a little money on it. And so great. So look, if the stock goes up, well, certainly you say, well, maybe it goes up to 110 or whatever. Well, certainly you don't want to sell it for 100 if it's 110. Now, let's say you don't own the stock. This is not a protective put. We'll do that in the risk management section. But let's say this thing goes down to like $5 or zero for that matter. That'd be pretty cool because over here, we're just looking at the big board on the market. You don't own anything yet. All you own in your financial statement is this put option. That's your asset, right? Income, expense. So look at this. You have this put tucked away that says, if you ever decide that you want to buy XYZ stock, if you ever decide you do want to buy it, before you get into that, you say, what? I'd rather have the ability to sell it guaranteed before I even buy it. Think of how cool that idea is. Just in case I ever want to buy it, why not lock up the ability to sell it before? Think about this. If you were on a cruise ship, would you want to know where the lifeboats were before you got on the ship or after? Right? If you get on an airplane, you want to know where that oxygen mask is before you take off or after. So, you say, hey, before I hop into the stock, I think I'd like the ability to sell it. And if you think it's going down, why not lock in the ability to sell it at 100 early? Because think about this. If it gets down here at $5, now you could go buy the stock at $5, right? $5, and you've got this set up to sell for 100 guaranteed. You make $95, and then they're both gone. You got cash, $95 right there. So understand you don't have to own any stock to do this. And what's really cool is, remember how I talked about intrinsic value? That if you paid, $5 for this, let's just call it $5 for this. If you paid someone $5 for us and it goes down to, let's say, $10, well, that's $90. That means you could now buy at 10 and sell at 100. The intrinsic value of that is now $90. So this $5 you spent turned into 90 plus any time you have left over. So it's pretty cool stuff to practice. And the best way to learn this is in the Mentor Club, where we practice. I'm not going to go in the Mentor Club for this one, but I think I will in risk management, just to show you some, it's very common for us to have these for protection. But right here, we're going to look opportunistically. So let's review that one more time, just for the sake of reviewing, is this person has a choice for sure. They have the choice, right? Has the choice, or have the choice, has the choice, whatever, to sell. And this person makes a promise. We'll just write that out there. Promise to buy XYZ stocks. So as you're selling your buyer, where's the premium going to go? This way. And you really need, a couple of things. You need a premium, you need a strike price, and expiration date. So the premium, whatever it is, goes this way, right? We have a strike price, so maybe we're going to sell it at 100, and this guy's willing to buy it at 100, and it's good for 2 months. Or, 12 months if you want to do a leap. So whatever, it'll always match up. So, pretty cool stuff. So let's pop out of theater mode here quick. Let's go into, some software, and let me just see if I can't, well, first, let's do this. Let's go back way in the way back machine. You're getting through the 4 pillars pretty far here. Let's go back to fundamental analysis, pillar number 1. And if you remember this, lesson in history, 2019, by the time you see this, this will be ancient history, is we had the company that in Japan that owns Fortnite, and these guys specialize in games that you can download. And then you got the old Blockbuster Video Redbox model of, hey, let's go get the DVD and put it in, or the disc and put it in. And GameStop, this retailer, we looked at some of their numbers, if you remember, and we were not impressed. We saw them losing money. We saw them, struggling with their income statement. And we said, this doesn't look too good. So let's look at their chart. Let's go to GameStop. Then we look at technical analysis, right? And we can just do that live. So let's pull that off and put those back in the right size for sure. In fact, we can just close that down. We won't need that again. And let's go to a chart, and maybe we'll just detach that chart. And I'll type in GameStop GME, and we'll look at this mess right here. Now, GameStop was interesting. So, way back, probably October-ish, something like that. I don't know when it was. Let's see. I can look it up. Just a second. I'll tell you when I did this. For October. So, right around here, this got my attention, right? I thought, wow, this has really dropped from 16. I wish I'd have done it much earlier, but this got my attention fundamentally. I was like, man, this thing's really struggling. And then we have this big gap down. It's sitting there. I'm wondering if it's going to fill that gap. I wonder if it's going to fill it back. And it just turns into a landslide right here. So right about here, I said to myself, you know what? I'm going to buy a put option. And I bought these right around here. I think it was like the 9th probably of April. So right about here, I said, you know what? I think this thing's in trouble. So on April 9th of 2019, I said, you know what? I'm not a big fan of GameStop. I think it could go much lower. And so I spent, I bought a bunch of these actually. But one contract, it was $1.78 per share. one contract would be 100 shares. So for $178, you could have participated. And, if you want to do 10 of them, 20 of them, however many you want to do. And I did quite a few of these. I was pretty happy with this. So I did quite a few of these. And what that does is so here's Andy right here, happy as can be. So now I have, watch this, I have the choice to sell this. And I said, you know what? Right here, it was at $10. And I thought, I'll just do it at the money. That's fine. I'll just do it at the money. And so it says, I'm going to have this choice to sell at $10. And now no matter how far down it goes, I'm going to be able to sell at 10. And so, it went, it gapped down, went. And, right around here, well, really anywhere around here, I'm pretty happy because here we're at $3. So the intrinsic value goes from $1.78, and these expired in October. So these just expired right about here. They just expired right about here. But, in this area, I have intrinsic value because I could go out and I could have bought this stock at, $3 or $4 here and sold it for 10, no matter what. Anytime before the 18th of October, which would have been right about there. Yep, on that line, right about there. So the expiration date was the 18th of October. Now, I let it meander, and what happened right here is it's the guy who did the Big Short. He says, I still think this is a good company, so it really got some steam. And, the earnings, they're losing money. You'll notice here the earnings went negative right here. They're losing money. And so, it looks like we've put in a lower high right here. It had a change in trend. Now it's changed back down. So I may do this again. I may say, you know what? I'm going to sell the 6s or buy the 6s and see what they are. But in any event, it got right up about, I have the ability to sell at 10. And right here on expiration, I let it go full term right around in here. So I get to buy it at 6 and sell it at 10. So that's $4, right, that I get to make on that of intrinsic value. So it only cost me $1.78. That's over double my money. That doubles my money in, a few months. I could have done even better than that. But that's pretty good. If you spend $1.78 and you get $4 out of it, I just let the time run. Because, you got this stuff happens. You very rarely are going to pick the bottom perfectly. So I just let that run and take my profit and say, yeah, I'll buy at 6, sell at 10. Thank you for the $4 times, in one contract, that'd be $400. In, 10 contracts, that's, $4,000. It just goes up from there. So however many you want to do. But that's a nice little, nice little gain. So let's say we want to do this again, right? Let's say that we, we're excited about this idea and we said, let's do this again. And let's say we still think it's, maybe I disagree with the Big Short guy. Some guy does one movie, everyone thinks he's a genius. I'm not going to go into the details on that. Sure, he was a good fundamental analyst, but they got really lucky on the timing, I think. So let's just do this. Let's say we add a simulated trade here, okay? And I look at this chart again. I say, well, it went down this far here. It's tough to go back down further than this. We got a pretty big support. And some people are like, heck, $3, shoot, throw $3 at it. And worst I can do is lose $3. So it's hard to get these to zero and go bankrupt because someone's going to say, well, $3, my gosh, I'll throw $3 in anything. What am I going to lose, $3? So it'll be hard, I think, for it to get below. But you'll see there, the earnings, get lower and lower and lower. And, you can see that it was pretty bad, in here and a lot of downward movement. And their job is to try to make these GameStops into like hangouts for people to go hang out and play video games together, create a social experience, which I just think the trend is, I think whatever guy took this thing over probably doesn't have any kids. I went to my kids, I go, hey man, you guys want to go hang out at GameStop and play? He goes, dude, why do you think we have the internet for? We can play with people in Australia if we want. Why are we going to go hang out together? So that's kind of their culture. So I don't think it's going to work. And I think a lot of this, there's going to be some short covering here. People like me that are buying to cover short. But we're going to look at both ideas here side by side, and I think this will be a fun thing. So let's open up. If I can find another place for this. Did I hide it behind here? Yeah, I did. So let's look and say that we want to do something long term, because remember, this is time decay, right? So we want to buy plenty of time. And so let's buy one way out. Let's see how much we can get one. Maybe let's just go way out. Let's say we think this thing could be in trouble. It's probably going to last for a while. It's not going to be in too big of trouble. I kind of like January that's too close. April. Let's go out a little more than a year. January 2021. We could do that, or we could do April. I kind of like these Aprils right here. So not quite a leaps. So here's the Aprils, and I can buy a put for even less than I did before. I can buy a put. Now that's quite a spread. 30 cent or 28 to 50. That's 30-cent spread. So I would probably, let's get a mark on that so I don't have to do the math. So right now it's at 602. So if I go right at the money at 6, and I say, you know what, for $1.43, I can do this, right? I can probably buy that for $1.43. So let's shave the spread down, so we're not paying full price. And just for fun, I don't know. Let's keep it reasonable. Let's do 10 of them. So that's $1,000. That's $1,500. If you only want to do $143, do one. So that's $1,500. And that time decay can go. So now if I hit my risk profile, you'll notice that the risk graph, I go from 0 to start having profit if it goes bankrupt. Well, if it gets back down to what's its low here, $3, we'll call it. So if we can get down to that $3.50, $3 right around in here, you can see that's going to be another chance to double my money again, right? Now you'll notice, if I can draw on this, you'll notice that this is the break-even line. So this is how much risk I have, right? But what's cool is this is the time decay line. So the green line is at expiration, right? The green line is at expiration. And so, I'd lose my, $1,430. So sure enough, right there, it's hard to see, $1,430. But you'll notice it's going to take some time for that to happen. Right here, I buy it and I could sell it the same day and not lose much, because it's really the purple line I'm dealing with before expiration. If you remember, if I march the time forward, this is going to take a long time because it's a long-term option. It's 4 months. You'll see as I march the time forward, that purple line starts to take the shape of the green line. See that? And so now we're in January, and now we're in February. Right, there's February. And you can see how that... if this thing just falls even to 5, I'm still at break even, right? I'm still, if it falls there. And we can keep marching forward until we hit April. And there's March. And finally on April 17th, right there. Now there's no more time left in it. So that's a fun game to play. And in the Mentor Club, you'll see us look at both the expiration line and that. So it would take all that time. Now, if the stock rises, see, I'm going to lose some. So we'll talk about exit strategies in the next one. I would say this is maybe what I say is, look, I'm willing to risk. We could look at the chart. We could do some technical analysis and say, okay, look, it dropped down here. If it goes back up here above 6, maybe 660, I say I'm out. I say if it starts heading up and it starts to break a new high and now it's an uptrend, I don't want to, be bearish on stocks and uptrend. So we say, look, if this thing gets to 660, which is right at its standard deviation, that's what this gray part is. That's too close. We need to get this in the right. That didn't look right to me. That's going to be much wider, I would say. April, what is it, 20th? We'll go 8th. There we go. This is the standard deviation for it. So yeah, if it gets to 650, let's say, or 660, you know what? I'd lose $239. I could live with that. So we'll risk $240 and take a shot at doubling our money. Maybe this thing tanks, right? We'll take a shot. So we'll spend $1,430, and we'll say, look, if it gets down to here and we're going to lose 240, we're out. So we have an entry, which is right here, an exit, which is right there, and then a target, which I think 3.5 is a realistic target. It's been there before. This company is in trouble. And this is what's really cool is you'll be able to look back and see if I was right or wrong. And I'm okay with either one. You know, someone say, well, if you're a stock teacher, what if you're wrong? You want to show a stock? No, I don't care. I'm here to learn. So someone's going to say, yeah, it really took off on you, didn't it? I go, yeah, I lost $240. Guess I'll have to take that of all the money I freaking made on the first drop, huh? You know, see that? And then if it does drop where I think it is, well, I'll double my cash, right? I'll double my money on this one. Now, doubling the money is a very aggressive idea. I mean, you think this thing's got to lose half its value to have that happen. But I'll tell you, I think that can happen in a stock that's this messed up. I mean, if you look at where it's been, 3 years ago, this thing's in trouble. In fact, let's see where it used to be. Like, I don't know, let's go back in a time frame like 10 years. Is GameStop even that old? I mean, look at this. This was a $55 stock. This thing's a mess, right? It's had its little rallies and its little people that say, oh, look, it's really, really cheap. Let's buy it. And you'll notice that this right here, this support, became this resistance right here. Isn't that interesting? But it's just doing the worst it's ever done. It may be out of gas. We may have taken all the money out of this that it has to offer. Maybe your people saying, boy, I got none to lose at $6. I'll throw $6 at it and see what happens. That could be. It's going to be harder to get it down because it's cheap. But nonetheless, if an institution's holding this, so they really want to hang on to this. So there'd be my exit, and this would be my target. And that's great. And maybe what I do is if it just sits in meanders, I have a time stop on it. If it sits in meanders and I have a $200, $240 threshold on that, maybe I get it down to about here. And I say, you know what? That's 297. Well, let's see where that is. That's about 307. That's too far. Let's back that off a little bit. And I say, okay, great. I'll wait till Christmas time. That's a good time. And if by Christmas, that's going to be just right. Merry Christmas. If by Christmas it's not paying me, look at that, 237, perfect. Then I have a time stop. So if it stays around the same and it's still there at Christmas, great. Maybe I pull it off and say, I'm done with this thing. A fundamental analysis saying that it's doing poorly doesn't mean they can't have a turnaround, right? It certainly could. But all things being the same, if it does continue to slide, and this company goes like Blockbuster, if it goes bankrupt by then, which it probably won't make it bankrupt by then, that's a huge windfall. That'd be a huge win. Maybe bad news comes out and I wind up making $3,000 on it. We'll see. But I certainly have much more potential to the downside than the upside. That's fixed. That's fixed. So that's how that would work. Now let's do this. Let's move this here. I'm going to show you something I think you might find interesting. Let's just short it, and I'll show you the difference of why a protective put might be as interesting to this. If we had a simulated trade and I say, you know what, I just want to short it, right? Just want to short it, and we'll do the same amount. We'll do 1,000 shares here. Whoop, wrong arrow. We'll do 1,000 shares. Nice. Let's just bring this up here and knock out these price slices. So here you can see I'm short 1,000. Doesn't show up well because I don't have enough space, but if I stretch this out, you can see it's 1,000 shares. So these are very, very much equivalent. And you'll see here that you got all this upside potential. Let's squeeze this down and get a 0 in here. like so. Whoop, moving slides. There you go. So yeah, it's interesting because if this stock takes off, you start losing huge. The most I can lose over here is about $1,400, but you can see if this took off and it got back, back over here, I could lose much more, much more. So it's kind of an interesting idea to look at this short. You could just keep losing. If they really recover and they become that $70 stock again, you're down 60 grand if you're short. But if it went to doesn't matter if it goes out to 60 again here, you see how this line just goes flat, and maximum risk is premium paid. The other thing is GameStop's not paying its dividend anymore. It pulled that, so I don't have any dividend risk, which is nice. But on another stock, if you're short, you have to pay that dividend, right? It's because you're borrowing the stock. So this is kind of fun to see the difference between a put option and shorting the stock, and what it would cost to to do those types of things. And you can play with it. If we wanted to really say we think they're going to be bankrupt within a year and a half or however long, a year, well, then maybe I go out here to short at 5, and it's not much more to short it at 5. Look at that. Than it was here. Boy, look at this. Here I'm getting 6 for about $1.40. Here I can go one strike down. I can get it for $1.59, and I get a whole nother year on that sucker almost to January of 2021. So not quite a whole year, but quite a bit, 8 months more. So yeah, those are put options where you can just do that. I prefer to use a put, a long put. As a way to hedge, as a way to protect myself. Most of the time in the spread trading I do, if I'm long a put, I'm trying to hedge something or protect something. And so that's what we'll talk about. So with that, let's do a summary, and I'll just do this right on the whiteboard really, really easily. Let's write down everything we know how to do. So we can do long stock, right? That's one we can do where we buy stock and we hold stock possibly, and we collect a dividend for cash flow. Dividend. And so we would draw that here, and we'd say, yes, we buy some XYZ stock, and it goes up and down, but we get paid a dividend. We'll just put DIV for that. So that's basic cash flow. And to tell you the truth, we used Kraft Heinz as an example of wanting a stock. We should review this just for fun, just so we don't forget, because this was a long section, man. This was a cool section. So let's go back to that pillar, if I can find it. Got so many charts open here. Yeah, I like this, pillar number 3. You go back to Kraft Heinz, and we were saying, look, we wanted to get a nice dividend. Here, Buffett, because he bought low and held it for a while, he's got a huge ROI on his cost basis. Well, Kraft Heinz fell so bad that we thought, hey, maybe 5.33 starting now, maybe we can do that. So that'd be cool. So that's one way, long stock. We buy it and we collect that dividend. Okay, the next thing we can do is we go long stock, and in this case we want to buy stock, and maybe we want to speculate with capital gain a little bit, and we say, we'd like to be like a house flipper and sell stock. Not my favorite thing to do, but there's times where I'll do it, right? And so here we're trying to get what's called a cap gain. We're trying to buy low and sell high. So what would that look like? Well, I'm not getting any cash flow for that, but if I have XYZ stock and I buy low and then I sell high, my net worth, I have more money than I did before. My net worth goes up, but there's no cash flow, no cash flow of this. It just gets more valuable, right? And then I buy and sell like a house flip. So in real estate, this would be more like collecting rent, right? In stock, this is more like, being a house flipper. right? Something like that. Okay, so that's another option we had. Okay, another thing we said we could do is we could short stock, right? And we did a very lengthy, 4 or 5 different classes or sections on shorting just because it's funky. It's opposite. We learned how to short. And it wasn't just important to short stock. It was important to, learn how to short the dollar, learn how to use real estate to short the dollar, learn how to short a currency, learn how to short a cell phone, whatever it was. So here we have X, Y, Z. And what we did is we borrowed, right? Then we sell. And then we buy back, and then we return. So this is kind of a nice review. So here we're going to, I could have wrote that up here. We're going to borrow the stock. We're going to sell the stock high. We hopefully get to borrow or buy back low, high. I should write that a little more neatly. And then we return the shares we did to the broker. No cash flow on this one, and we're hoping the stock goes this way instead of this way. Okay, then we said we could sell a put. And I love this idea. This is one of my favorite things to do, where we have cash in here, right? So we can keep a promise. And what we do is we say, we're going to make a promise to buy. And so if you look at this one and you say, look, I want to be long anyway and collect the dividend, right? I want to be long anyway and collect the dividend. Well, I have the cash here ready. Why not promise to buy it? And in this case, we're going to collect a premium, which lowers that cost basis down even lower. So this is a wonderful 1-2 punch I like, where I do this one first and this one second. And I might do some covered calls. In fact, we could say we had a covered call, and we didn't do naked calls. That's for the advanced options class called Ultimate Options. But we had a covered call. And what a covered call is, a cash flow strategy where now I own the stock and I could collect the dividend, but I could also make a promise to sell. And maybe I make that promise to sell higher and I collect a little bit more premium. So we have cash flow here. We have cash flow here. We have cash flow here. And in these two, we have capital gains, right? Then the final one we did is just like long stock. We had long call and long put, which are the same idea, where I buy a put or a call, and I want the value of that put or call to go up. If the market goes up, then the call goes in value. And so this is also like a flip, where I'm buying low and selling high, whether it's a call or a put. And so those are 1, 2, 3, 4, 5, 6, 7 different strategies. And I think that's good for a paper trader. I think that's good for a beginner to choose between those 7 strategies. I very much love I'll tell you my favorites right now. My favorites are these 3. I love that little 1, 2, 3 punch. And I think what I'll do is, we used Kraft Heinz as an example, and we've had some time go by as we built this new class here and there. And I think I'll bring in Corey Halliday, and I'll just show you, what that looks like for, when we start that in March, April, May, June, July, August, September, October. We'll just show you what that looks like doing that for 8 months with the stock. And we've been doing it for 8 months with Kraft Heinz. And what's going to blow people's minds is that thing hasn't even gone anywhere in 8 months. It's kind of gone down and up and down and up, and it's stock in a box, very little movement in it. But people are going to be, you might be blown away when you see what we were able to do with just these strategies right here. Long stock, selling puts, and selling calls, just that strategy. So it'll be fun. Again, the ones that are the cash flow strategies are collecting dividends, collecting premium from selling puts and selling calls. And then these are the flip strategies right here. So you can do either one you want. And I gave demonstrations of a lot of them. So with that, that's just absolutely awesome stuff. Bring me over some action steps. And this is how I'd wind up the cash flow pillar. We've already been practicing some buying and selling of stock, and I told you to practice to short some things and practice shorting. So since then, we've done the cash covered put, the covered call, long call, and a long put. And so I'm going to challenge you to paper trade a few of these and learn how to buy a stock. It's great to do this a little bit out of the money, so it has a dip to it. Again, we do this on paper, so now's the chance to start practicing 3 of the 4 pillars, right? Make sure this is done in a paper trade account. We haven't done risk management yet, but do a fundamental analysis on a stock that you like and say, I think I'll sell a put on this. Some examples of stocks that I've done this on. If you want to get more clear on, well, Andy, what would a chart look like to do a cash covered put? When would you do that? Well, let me bring up a chart here real quick. Let's get off GameStop and let's go to, I'll show you a bunch that I've done this with. Coca-Cola, I did this with. Let's go back to a daily chart with maybe a year. See this gap down right here on these earnings? So they had a bad week of or a bad month of earnings, big freaking deal. So what I did is I started selling puts right here to get paid to buy the stock, and we did. And man, we've done very, very well on that one. Another good example, Johnson & Johnson. They had this big lawsuit come in, and their powder is bad. So this is a great place, I think, to sell some puts. If it goes a little further, you get put to it cheap. 90-cent dividend, what's not to like there? And you get paid to buy something cheaper. When it has decent fundamentals and there's just something that's got everyone freaked out in the short term, lawsuits usually aren't devastating a company. You got to do your homework, though. Got to do your homework. There's a lot of them. Intel, same thing. This thing just falls to pieces. Nice times. And now I've got some support down in here. Nice times to pick this stuff up when they're falling. That's when I love to sell a put. And if it goes up, I keep the premium. If it goes a little further, it gets put to me and I get to enjoy the ride. You can do a combination of both where you buy a little stock and say, hey, I'll buy 100 shares. And then maybe I'll do a put that if it goes lower, I'll get another 100 shares with even lower cost base, get paid to do it. So you can do these in combination with one another. And there's all kinds of opportunities, to do stuff. Facebook has like the largest database probably in the history of mankind. I don't know who's bigger than those guys are. Let's go with 3 weeks. And right here, they just went into a landslide, right? They've had big gap down into this. That was really ugly. This is a chance to do this. Now look at this. If it gets put to you, now you have your exit, which we'll talk about, right? But this would be a time where on something like this, with a week like that, if we can go daily, I love to do it after a nice gap. So let's go 3 years. We'll find that nice gap right here. See how nasty that was? And so, maybe I pick it up right here and I say, no, I got a little kiss goodbye. I'm out, so I pick it up and I'm out. So, some of them work, some of them don't work. Some of them recover, some of them don't. But you always have exit strategy. Covered calls, we've done these on KHC, where it's been a stock in a box. And we just say, hey, you want to buy it from us at 35 or 34? Be our guest. We can buy back in. Coca-Cola pays a decent premium sometimes. There's a lot of these. I've done this on silver forever. I've had some FLVZ, and I ride this up and ride this down, ride this up. But I'll tell you, I've been collecting premium on this for 10 years. And I just use my technical analysis to let this thing go up and down and up and down. I just collect that premium. This to me is like a really, volatile housing market, where I'd be collecting rent all the time. So I'm not recommending these at all in any way, shape, or form. I'm just showing you examples of what that stuff can look like. Okay, buying a long call. We looked at Caterpillar as an example here. Let's get this back down to a daily chart with a year time frame. So with Caterpillar, we got to get rid of this box. We don't need that anymore. With Caterpillar, it gapped up, and we said, hey, let's gamble. And let's throw 23 cents at it, right? It looks like it's pretty steep. This thing seems to go and dive and bust. Big, long candles when it really takes off. Great big candles. So we speculate a little. When we do this, just to review, okay, when we sell, what is the time decay? Well, if you get 6 weeks, I even like a month or less, you'll have better time decay. But if you're going to buy this stuff, notice that we love 2 months minimum or more. Now, we've done a few shorter than this one. Caterpillar was shorter, but we're aware of the time decay. So these are not hard, fast rules that you can never break, but a person should understand conceptually that if you're buying an option with less than 2 months left, that's not a lot of time for the milk to stay fresh, right? You probably want to reach back in that dairy section and find something with a little bit longer expiration date. What's really cool is there's only 4 things you can do with options. You can buy a put, you can sell a put, you can sell a call, and you can buy a call. There's only 4. Huge amount of combinations. You think of a 4-digit PIN code, how many combinations there are. Well, it's not quite that many, but we ought to do this. And then, in the first time we did 4 pillars, we didn't look at any risk graphs, simply because, let's go back to that GME risk graph, simply because I felt it might be too advanced. But you know what? If you're willing to, get with your coaches and get with me and, stick with that, we like the idea of people starting to learn how a risk graph works, how to look at the price as it goes up and down and find out how much money it's just a great visual to hop into the next one. And the reason risk graphs are important is, guess what? We congratulate you. We're going to give you your trophy here in a minute for finishing cash flow. But before we do, just remember, we're going to be exploring those risk graphs. And then if you're in the coaching program, congratulations. If you're not, consider getting in it. And you can always hop in on a cycle and do a round of 4 pillars with a coach. And so that's awesome stuff. Really, really awesome stuff. Cool. So with that, watch this. We're going to come down here and bam. Hey, congratulations. You've just completed the 3rd pillar in the 4 pillars of investing. Biggest pillar we have, cash flow. So we'll see you next in risk management. Great job.